Welcome to the second session of Axiom Valuation's educational webinar series, Countdown to the Closing of the Gift Tax Window, a Valuation Perspective. Thank you for joining us. We have a number of attendees, plus a bunch of people who have asked us to send them the recorded seminar, so we're just going to move forward with the seminar. Our next webinar is set for October 23rd, also at 11 o'clock, and that topic will be valuing non-traded debt, of which the issuer may not be a going concern. Somewhat of an interesting question from the valuation perspective. But for this webinar, we think that the current conditions are the most advantageous for gifting. They have been for the last, since the beginning of 2011, but in this case, obviously the window of opportunity is closing in many ways. So we'll go through these issues. We hear from a number of advisors that their clients who have not made the decision yet have found the process confusing. They don't like the pressure of deciding something by the end of the year. And we've thought about that as just some of the questions that may come up, and certainly one of the big areas of confusion is valuation discounts. What types of discounts are possible? In what circumstances can they be applied? What are the range of expected discounts? And what are the likely IRS challenges? So in thinking about how a high net worth household or individual may be thinking about these and the fears they may have, we put together the following construct to look at the factors that impact gifting and what their current status is and how they may change in 2013 and beyond. And we put together some basic information on the types of discounts, some of the current ranges, and how they're applied. Finally, we will look at some data on audit risk and information on the IRS review process. Again, so if your clients have any questions about this at least will put some perspective around it as opposed to just general statements. We'll put some data around all this. Please type in any questions as we go along. If it is an immediate question, I will address it at the time. Otherwise, we will have time for questions at the end. Just briefly, I am Roger Winsby, and I'm president of Axiom Valuation. And I'm trying to get my screen to go next. I focus on business valuations, FLP valuations for gifting and estate purposes. And I'm still trying to get my screen to move forward here. Okay, I'm going to try to. So focus on gift and estate tax, buy, sell, selling or buying. As many of you know, but for those of you who don't, Axiom, thank you, is 100% valuation firm. We work on private businesses, public entities. We work on where they're thinly traded. We work on the illiquid securities, interests of hedge funds, fixed income portfolios, and intangible and tangible assets for financial reporting. We're based just outside of Boston, but we work all over the United States, and we've done a number of valuations outside of the United States. And just for reminder purposes, this is for educational purposes only, and we're not rendering any legal accounting or professional service through this seminar. We'll go through these basic topics, best to look at it from this perspective. What we're looking at here is the decision to gift. And obviously control is a big part of any decision to gift and what people are planning to do. But once you get beyond that, then the question really becomes, from a timing perspective, what are the tax rates, the size of the exemptions, and what are the likely changes? that's obviously a very big factor, and that's the big reason we've been talking about this current window. Another big factor is asset price levels and their direction of change. As we all know, 2009 was a low point for the stock market, but the gifting opportunity was not as great simply because of the exemption size. A third area is valuation discounts, what's changing there, and there has been some change going on there, and what could go forward. And then finally, the risk of audit, and that can be influenced by both the political environment and the time, time available for given the resources of the IRS. So we're going to look at some information about each of these four areas. So the first one, we'll just go very briefly through this. This I believe you're all familiar with, but just to go over it as a handy guide. We're in this particular window that started with the Tax Relief, Unemployment Insurance Reauthorization, and Job Creation Act, which for 2011 and 2012 created a lowest gift tax rate in some time, 35%, and an alignment of the exemption for the gift taxes of $5 million in 2011, $5,120,000 in 2012. It harmonized it with the estate tax as well for these 2 years, both the rates and the exemption amount. And if no action is taken, and certainly we see, in Washington, no action is certainly a possibility, this would revert back to the 2001 levels. So a top tax rate of 55% for gift and estate. Exemptions would go down to $1 million. We put the generation skipping tax information here, but we're not really going to focus on that for this presentation. So in the thinking about, okay, what else needs to happen? So Congress and the President need to act if this is not going to happen. Most people don't want the rates to go back to these levels. But what's actually on the plate between now and the end of the year? Not much. Just the sequestration issue in terms of the agreement from last year that if there was no agreement on a plan on the deficit, that there would be automatic cuts. So they have to deal with that. Likely the debt ceiling will need to be increased in January 2013, and obviously we've got elections. So there's a lot going on right now that would make you think that even though the issues around estate and gift tax will potentially be part of the sequestration discussion, they're actually probably a fairly small part of that discussion. We do know that the President has put together proposals in the 2013 budget release, and so basically kind of an opening gambit from the side that would tend to argue for higher taxes, that they are saying, well, yes, we can see the gift tax rate go up, not to 55, but to 45. But the exemption still drops to $1 million for gift taxes. The same rate on estate taxes being proposed, but the estate tax will then be separated in terms of that exemption, that you'd have a $3.5 million exemption on the estate tax level, so the gift tax would be somewhat out of sync. So that's what's at least one possible outcome to think about. But basically, with all the uncertainty and the political deadlock, it's likely to go up from 35%, highly likely to go up from 35%, and it's, I believe, likely to go down significantly from the 5.12 million. So from that perspective, just from the perspective of these exemptions and rates, this is a highly propitious time to be focusing on gifting. So the next topic really gets to that question of asset price levels. I'll do this very quickly. No great news here. Asset prices have improved, certainly in the stock market. The opportunity is there, but I think many people feel the stock market will not be taking off in 2013. So, from that perspective, now is as good a time as any. We've got asset values for many types of items, stock in both public and private held companies, real estate, family limited partnerships, farm assets. All of these are generally at higher levels. Again, all real estate is local, but generally these are higher levels. But at this point, given the trend in the economy, unless you think that there's going to be a significant recession coming up, this is still probably as good a time as any to gift from that perspective. So what's the question then about discounts? And we especially want to address this question because oftentimes we hear people commenting, even on valuation webinars where other experts listen in to other experts. There's a discussion about people can say, I can get a bigger discount than the next valuation person. And at the end of the day, while facts and circumstances really do predominate in every case, there are a very specific set of rules and expectations in regards to discounts. And rather than make that magical and mystical and try to confuse your clients and confuse you, we think that it's actually helpful for you, the advisor, to understand somewhat about what's actually going on here. So the IRS provides some information each year about gift tax returns. They have, in the 2008 analysis, which came out in the spring of 2011, they actually provided some information on discounts. So within those 234,000 gift tax returns filed, there were gifts on those tax returns, 102,608, where discounts from the reported fair market value were applied. As you can see, a fairly small percentage of those were taking less than 20% of a discount. A larger percentage between 20 and 40. And then we've got greater than 40%. So it does tell you that the gifting opportunity discounts have been significant, and they've been really taken, advisors and valuation people have been able to take significant discounts. And this doesn't tell you anything about whether they were challenged or not, but as we will see later on, there's a relatively low challenge rate. They also tell us something about the type of gifts for which discounts were taken. Now, this is a little confusing, not in itself, because it says, okay, public and private stock. That's not a very helpful delineation, because under most circumstances, you should not be able to take that much of a discount on public stock versus private stock. Real estate obviously is an area for taking discounts, but it gives you an idea that the big three really are in the stock area, real estate, and the partnership area. Now, we believe that actually the bulk of this is being done. All of the discounts that show up under the stock area and real estate and partnership, most of that is actually being done through some kind of partnership or corporate entity. And we'll explain that a little bit more. But again, you see these are the items where the bulk of the work has been done and the bulk of the discounts have been taken. So what are allowable discounts? Well, for the direct gift of assets, the discount opportunity is actually very limited, except for privately held stock. So let's just go through that. So in the case of a high net worth individual that has a large stock portfolio, if they make a direct gift of that stock portfolio to a family member, there really is no discount opportunity. It's a publicly traded stock. We know what it is. It's not bound up in any other entity. It's a direct gift, very clear. You should not be able to get any discount on that. With real estate, if you give 100% of the real estate just as is, then the net asset value of that real estate is what the value of the gift should be. If you give 50% or 10% or some percentage of a real estate parcel, there is the opportunity to take a fractional discount. However, that is limited. Typically, you see those in the 5%, 10%, occasionally a little bit over that. Where you do see the significant discount opportunities is in the direct gift of privately held stock. And that can be stock in a going concern, a private company, or it can be stock or partnership interest or membership interest in a LLC or partnership or LLC. And those two primary discount opportunities are considered lack of control and lack of marketability and liquidity. So lack of marketability and liquidity is, we'll go into that in a little bit more detail. They actually are slightly different, but in general parlance, people use them in the same way, so we're just going to treat them as one general class. There is a third case, which has actually emerged over the last several years, where if the assets, for some reason, are in a C corporation, and you're gifting the stock of that C corporation, there is a tremendous opportunity to take a discount for the built-in gains that are implied if the assets within the C corporation are sold. And we'll discuss that at the end. Again, it's a fairly specialized case, but there is an opportunity there for significant discounts. So the way that you get discounts on stocks or real estate or any of the other items, cash or not much for cash, but for bonds or any other of those items, is to place those assets into a partnership or an LLC or into another corporate entity and then gifting the securities of those entities. That is really the whole logic process behind valuation discounts. And the discounts then allow you to give, as you see in the table below, if it's a partnership, the controlling partner can own 1%, the general partner, and they can transfer away the limited partnership interest up to 99%. And those limited partner interests will reflect a discount for the fact that that limited partner has no rights on the sale or sale of the assets, management of the partnership. They just have a right to the distributions. Same thing with an LLC. You have to structure it somewhat differently, but you can get similar effects where you've got a managing member with a small percentage interest, or no interest actually. They can just be the manager, and the members have no real control. In a corporation, it's a little tricky because you have the issue of, as you do in a standard LLC, of 51% or 50.1%, meaning control. But even in corporations, you can do voting and non-voting discounts. So the first element of discounting relates to being able to transfer interests that do not have control. The second element relates to the fact that all of these securities, because they're not publicly traded, and they often have restrictions, significant restrictions on the transferability, they have a discount for lack of marketability and liquidity. So we know that the bulk of, in 2008 at least, that the bulk of the situations where gift tax discounts were taken, that they were 40% or more. So the federal government and the IRS, in terms of how do we try to get more revenue, they've been challenging this. The first line of attack is essentially in the case of the FLP or the LLC, is where the IRS challenges that whether the entity has a business purpose. And that is a very good point that basically relates to, is there something that is being done with these assets, which are generally, again, part of a family type of assets? Is there something about this that appears to be just being done for tax minimization? So this is a situation where, think about this, the example where you've got a stock of a closely held company where it's owned by the parents and they want to give some of the stock to their children. They can give that stock, and that stock will reflect, if they're giving, let's say, non-voting stock, that stock will be discounted by lack of control and lack of marketability. And the IRS is not going to challenge that. But let's take another case where again, same closely held company owned by the parents, but they transfer that stock to an FLP. And then they make transfers of the FLP interests. In that setting, the stock it becomes the net asset value of the family limited partnership, and then what is transferred are the partnership interests, which are then discounted a second time for lack of control and lack of the marketability. Now that's the case where the IRS can at least make the case that if the only asset in that FLP is the stock of a privately held company where all the family members who are owners are both stockholders of the company and partners in the limited partnership, the IRS could attack that and say there's really no business purpose. You're not doing anything separate. So this is one of the areas where you have to be very careful in setting up FLPs and LLCs. What you put in there typically is the best thing to do is put multiple types of assets in there, and then also to maintain form and function. But if the IRS is successful, no discounts, basically no transfers have taken place. It's a sham transaction. So then the IRS will go back and say, we're going to assess a gift tax and penalties. The second line of attack is in the President Obama's proposals in the budget to reduce or eliminate disregarded restrictions. Now, this is a somewhat unclear area unless you really dig in and see what the details are, but this really is an attack on discounts for marketability and liquidity, and we'll go into that a little bit more. Third line of attack is there are, on a regular basis, other legislative proposals to raise revenue which eliminate or restrict the use of minority discounts for family entities, again on the basis that these are really somewhat sham transactions from a business perspective. So again, the first push is to say there's no adequate business purpose, it's all tax minimization. Second attack is even if there may be some business purpose, they never set up meetings. The FLP did not have partnership meetings, they did not keep minutes. So very critical point to make to your clients that if they go this route, if they accept the notion of creating an entity like this, they are buying into an ongoing cost and activity burden to make sure that they meet the standards, or else they run a serious risk of getting challenged. Now, to the proposal for the non-actively traded businesses, the very interesting and potentially scary part of this is that as you read it, because it technically, the statute that's being proposed would change the application of a statute that was passed in 1990, the change is proposed to be retroactive to 1990, which means that for all the FLPs that have been put in place since 1990 and have transferred gifts using a lack of marketability, that potentially there would be a liability for that. We certainly think that would be politically very unpopular, but nonetheless, that's the language. And then just the final thought here is that with sequestration and all the other issues in the debt ceiling, that there are obviously incredible battles over closing loopholes, raising revenue. At the end of the day, there's this ongoing push to say, take out these kinds of discounts for family-related entities. So there is a risk that the discount environment may change. It's not going to change presumably on January 1st, but it may change in the next year or two and change for the negative. So let's talk about this, and to give you an example. So hopefully, if you're sitting down with your clients, you can help. This will help make sense of it. So what we've set up here is a limited partnership, XYZ limited partnership, where there's a general partner who's the parent, and they have set this up. They put assets into this partnership. They put an set of apartment buildings worth $5 million today, and a stock portfolio worth $3 million today. So from your basic understanding of this, there's an $8 million net asset value. And if you think about it, well then, a 1% interest is $80,000. this is how you basically would think about this if these were just independent assets. And that's the way generally people think about these things. But if you put it into a limited partnership, all of a sudden you've introduced the notion that this is now a business that issues, that has, in essence, securities, that has limited partnership interests. So as we look on the right side of this, we see that the general partner, Xavier Y. Zillow, it's a 1% interest, and with that 1% comes complete management control over these assets. Now, Xavier is also a limited partner who owns 49%, and that's a right to the economic distributions, but no control in that interest. Xavier has already given to Junior 50% of the limited interest. So at this point, we have a case where all the decisions are made by the general partner, and you've got two limited partners, one with 49%, who's also in person is the same person as the general partner, and the other 50% owner is the limited partner. So what kinds of discounts, should be available to value an interest of this 49% non-controlling limited interest? Well, the answer to that is the discount for lack of control depends entirely on the assets as of the valuation date. So this is well established now. I mean, the IRS doesn't like this, but it's well established that this is how it's done. Discounts for lack of control for any of these items must be based on the empirical data by asset type. And so we as valuation people, buy access to partnership profiles, which has real estate asset types, publicly held partnership profiles, oil and gas interests, though those are out of date, but they're still something that you can use. And then for stocks, bonds, mutual funds, hedge funds, the requirement is to look for closed-end funds that have similar portfolio composition and see what the price to NAV is. For privately held companies, the source for lack of control, there's multiple ways to do this. One is a merger stack control premium study. Typically, we do analysis that looks at adjustments for transparency and independence from owner control to get at how to calculate a minority value. So at the end of the day, these are going to create the context. These are the empirical sources that create the context for calculating a lack of control discount. So the partnership profiles is really a critical source for this. It's built off of this database of 340 publicly held limited partnerships. What's of interest to us now is that for most categories, the 2011 data, which was made available in December of 2011, is still the only available information we have for 2012. And the April-May values for 2012 won't be available till December of 2012. So we all have a way of handling that. We just update the movements using monthly closed-in funds from real estate funds. But right now we have the 2011 discounts for most categories are at the highest they've ever been. And we're not sure if when the numbers for partnership profiles come out in 2012, whether those discounts actually may be lower. If they're lower and we're doing the work, then we have to use the ones that are available. If we're completing work now, we use what is known now, and that would be the 2011 data updated. Now let's look at our example, because in the Zillow XYZ case, they owned apartment buildings. So what we've done here is just show you what the level of discounts, or what we call the price to NAV discount history, is for multifamily apartments over the last 6 years. So in this case, we've got a situation where we know what the limited partner, these are publicly traded, right? So we know what the price is of the partnership value for a limited partner, what they're willing to pay. And once a year, they tell us what the NAV is. So the net asset value of the properties in that partnership. So that tells us what the price to NAV is, and that because these are limited partners, publicly traded partnership, this is the best proxy for a lack of control discount for a privately held partnership. You can say, really? Well, it's the best we have. And the IRS accepts these, the courts accept these. And you see, right now, we've got in 2011 about a 45% discount just for lack of control. So that's why these things are very important to understand. These are the kinds of things, if someone were to say to you, don't be aggressive, only ask for a 30% discount, and you own a multifamily apartment partnership, that's bad advice. What the IRS or the courts would be looking for is what's your basis for that. And if you can relate it to similar assets and show that the current discounts, price to NAV discounts, are 45%, you take 45%. So this is really important context for you to understand and to explain to your clients. This is not a high-risk strategy. This is working within the system and using the data that's available to support the case. Now, I've left these other ones in just so you get a sense. You can look at them later. Retail buildings is one case where the discounts have gone down somewhat. Land partnerships, very high. These are typically non-income producing partnerships. So these can be applied 55%. Again, it's empirical. It's the best available data. So that really covers the lack of control for real estate. Before we get into the full liquidity discussion, let me go back over the stock portfolio portion that we talked about in our example. What we would do there is put together a portfolio of stock, that portfolio of stock, and match it to a series of closed-end funds and see how they're trading. Because again, some closed-end funds trade above NAV, but most trade below. And again, the discounts typically, depending on the time of year, can range, and the business cycle can range from maybe 5% to sometimes 18, 20%. Most times somewhere in the 12 to 15%. Now, if someone told you that they got a 70% discount on a stock portfolio, you got to wonder, what were they doing? Again, it's got to be tied to empirical data. So that's how the whole lack of control process works. But now we've discounted for lack of control. But the second discount relates to the fact that these securities are not publicly traded. You can't go buy one in the NASDAQ. There's no coverage by equity analysts. And then, as you, I'm sure as all of you know, as you read through these documents, significant restrictions on the transfers. Can't transfer outside the family, right of first refusal by everyone else to limit the potential set of buyers. All these kinds of things go on. There are other sources, as we talked about, for calculating this, and these typically range between 10 and 25%, on top of what we just talked about for lack of control. So let's go back to XYZ, and let's look at it from the left side, assuming for the moment that these are just, apartment building stock, net asset value, 1% is 80,000, 49% is 3.920. Straight up, that's what it is. But when we put it in this other category here, we've now put it in the XYZ LP. We can take a 44% discount on the apartment building just for lack of control. We took a 12% discount on the stock portfolio. So then we got a net asset value of $5,440,000. So again, we take the 44% here to get the 2.8 adjusted value. 3 million gives you 2.640. Add it together, 5,440,000. 1% of that is 54,440. We apply a discount of 25% for lack of marketability and transfer restrictions. We then subtract that amount, and then we multiply by 49, and we get 1,999,000. So we've got a value reduction from the straight up net asset value of almost 50%. All very well justified as long as Xavier and Junior have meetings, talk about how they're managing the portfolio of assets, what they're doing to bring junior up to speed in terms of the transition, if there are other family members they're going to bring in. There needs to be form to this activity. It can't just sit there and not have anything. It should have its own bank account. It should have, obviously, as I said, meetings. So this is the way that you get those kinds of discounts. So trying to get down to the next page. Okay. Sorry about that. So we have a risk of audit. So again, let's put some data around this. The number of gift tax returns over the last 2006 to 2009 period has ranged from 223,000 to 257,000. And surprisingly, 2009 was the lowest, even though many asset values were low. And certainly we saw a lot of activity in 2009 because of the low level of asset values. And most of these returns actually result in no tax due to exclusions, deductions, and the unified credit. We see down here, these were filed in 2010 for 2009. Number of non-taxable returns was 213 out of the 223. $37 billion of gifts, exclusions, deductions, and finally a tax of this amount. So there's it's a big number at the end of the day, $2,453,000, but you can see what the effective tax based on all these exclusions and such, it was actually fairly low. We certainly expect, based on what we're seeing and hearing other people in the valuation and advisory community, that 2012 will be the most active gifting year ever. And sorry, again, I'm having a little issue there. So there's not very much information available. I found some studies that where the IRS provided some information where 0.6% of gift tax returns were audited in 2006. In contrast, 9.3% were audited of the state tax returns were audited in 2008, and of those, the ones that were $5 million, 21.6%. The general conclusion is gift tax returns have generally been less likely to be audited because when the person dies, then there's all the look back to see, okay, the state tax versus gift tax, what's gone on, what have been the transfers, so they can still address it at that point. So certainly, from a likelihood of audit standpoint, if there's a record number of gift tax returns filed, we think that will reduce the likelihood of an audit simply because the IRS resources have not been significantly increased. However, there's a risk that if in the next 3 months you've got to put everything into an FLP or an LLC, get all the steps done, that's going to be a little bit challenging. If the FLPs or LLCs are already set up but the gifting hasn't taken place, there's still time, but we know from our workload and from talking with others in the industry that there is going to be a real crunch to get things done in time for December 31st. Certainly things to watch out for, if you're doing something quickly, would be mistakes in timing, documents, dates of appraisal, certainly issues about economic substance challenges. Will the person gifting all these things, will they actually have enough money for themselves? Obviously, is the gift giver competent to make the gift? Again, just reminding over and over again that you need to demonstrate that these gifting entities operate independently and have documentation. And finally, again, be careful about if you're talking to someone about discounts and they're telling you they can get very large discounts, just make sure that they can tell you what their empirical financial analysis is going to be to support those kinds of numbers. So as we look at the factors influencing the decision to gift, we think that from a standpoint of what's going on with the exemptions and the rates, very favorable. From the risks audit side, we think it's actually very favorable as well to do something now. Asset price levels, they are what they are, but we think they're probably reasonably favorable. And the discounts are both high right now, and they may go away over some period of time or be somewhat restricted. So overall, we think the future conditions are going to be more challenging. Clearly people will always have gifting opportunities, but if, as the exemption amount goes down and some of these other limitations go on, we still think that this is a unique opportunity if all other issues being the same. Now let's talk in the last couple minutes we have here about the IRS review process. Just again, so you may know this, but just go over this so your clients know. All these returns are filed with the Cincinnati Service Center. They're obviously checked for completeness and accuracy. They are reviewed by typically what's considered the cream of the crop on the individual side. State tax examiners by administrative territory. They're all attorneys. They have the most experience. And certainly, from what we have learned, most cases are resolved at this level. There's a fairly sizable workload burden on the examiners if they push things up. So there's a lot of opportunity to get this settled initially if there are any questions raised. There are three formal levels of review: state tax examiner, as I said, administrative review in the appeals office, then litigation. The primary situations where the resolution does not occur at the examiner level is if the examiner says, I disagree so much that we're going to go out and get an IRS valuation engineer or an independent valuation analyst, or if the gift is simply not backed up by timely analysis, or if there's a dispute on a significant point of law. Now, in terms of recent court cases, one interesting thing has come up in 2012 that provides some openings here. It's where the taxpayers gave a dollar-denominated gift of interest with the percent transferred to be dependent upon the valuation. So they gifted up to their exemption at the time, which was back in, I believe, 2010. And the IRS challenged that. The couple won in tax court because they said they should be able to specify a dollar amount. So that allowed them to say, well, so no matter what, we won't owe more gift tax because it's just going to be up to the dollar amount. The IRS was successful in saying that the discounts taken were too aggressive, and the court raised those values by 20%. Just briefly, the built-in gains for assets in C corporations. There is a significant tax, built-in gains tax, when assets are sold. So courts have increasingly been willing to allow almost a dollar-for-dollar deduction for that built-in tax gain. So that's another special case that one should be aware of if there's an opportunity for that. So those are the issues that we basically see going on right now. The time is tight, but we still are starting projects every day. We expect to be able to complete a number before the end of the year, and we think that's true with other people we've talked about in the valuation practices nationally. And obviously careful planning and close coordination among your advisors is essential because these are going to require getting the forms right, getting the appraisals right, all the discounts taken. So with that, I'd like to take questions. The recording will be available on our website with the full set of slides for you, for those of you who are interested. So any questions, I'd be glad to take at this time. Let's see, now I'm just trying to figure out how to see the questions. Okay. You talked about the built-in gains tax discount opportunity. What happens if the C Corp has converted to S status? Is there still a built-in gain calculation? Great question. So one question is when did they convert and how long do they have to hold it? So the feeling is that you can still take a discount because the courts have ruled that the fact that a C Corp could elect S Corp status and in 10 years currently, but in the last couple of years, 7 and then 5 years, get full S Corp freedom from the built-in gains. That one does not consider that when one's considering whether these discounts should apply. So the issue would be that you would need to have a value as of the date of conversion, because that's going to lock in your built-in gains. And then you would need to look at the facts and circumstances to see whether typically entities like this tend to sell their assets. We worked on a case where it was a company that owned, a C company that converted to S, owned multiple apartment buildings. We looked to find an empirical base that apartment building REITs tend to turn over about 10% of their units per year. We were able to use that information to come up with a set of scenarios to come up with a discounted value. We couldn't take the full built-in gains tax discount because basically if they hold it for 8.5 years, they have no liability. But basically you can work through the facts and circumstances and take a discount. Okay, let me see if there's another question. I've heard of situations where limited partnership interests were discounted by 70% and they were accepted. Have you seen discounts that large? Very rarely, and very much tied to facts and circumstances. You can see situations where interests are locked up for some long period of time, perhaps for regulatory reasons. One case was a bank, holding company bank, where the stock was essentially restricted for any activity for a very long time. But in general, those are high, and even in the case of we looked at the non-income producing property, land, where the discount for lack of control was 55%. You take another 25, they're not additive, but you would get something probably around in the low 60s. That would be supportable based on what we've got. But anyway, so I think we pretty much reached our time limit. As I said, thank you all for coming by. Thanks for the questions. We will make this webinar available on the Axiom Valuation website. And if you have any further questions that you'd like to call or email about, please feel free. Thank you very much.